Okay, hey everyone. Thanks, Renee. Thanks to Investor Inspiration for having me here. It's my first time presenting here. My name is Michael Valtos. I'm the founder and trader at orderflows.com, and the topic today is order flow made simple, how order flow analysis will dramatically improve your trading. Before I get started, though, I got to go through a brief disclaimer. Don't want to get any legal troubles. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. I say that. I've had people come up to me literally, the only money they have is the money that they have to pay their mortgage with, and they want to start trading. I tell them, please don't focus on more important things, and then you can start trading. So let's get started. My promise to you, I, Michael Valtos, I'll promise to share my exact methods of order flow trading that made me a successful institutional trader and allowed me to retire from the corporate trading world at the age of 43. I promise that by the end of this presentation, you will understand the importance of order flow trading, understand the importance of the bid volume and the offer volume, be able to determine where support or resistance will be in the next bar before it happens, and how to quickly and easily see areas of price rejection in real time. I promise to show you how easy it is to use order flow analysis. Lastly, I also promise that if you see it through to the end of this presentation, you'll be in a great position to become a successful trader and finally become profitable if you're not already profitable. Today I'll explain the importance of order flow analysis, how to profit from analyzing the differences between the bid volume and the offer volume, how to determine where support and resistance will be in the next bar before it happens, how to quickly and easily see areas of price rejection in real time. Now, these are just some of the things of order flow. I could spend hours talking about all the different nuances of order flow. But this is just a primer to get you started, get you interested in order flow. And if you're not already using it, or maybe you're familiar with it a little bit, you need a little bit more education, and hopefully you'll pick that up today. So, my bio, who am I, why you should listen to me? Well, let me just tell you a little bit about my professional history. In 1994, I started on the CME floor with Dean Witter Reynolds. You'd have to be above 40, don't know what company that is. They were bought out by Callion Futures back in the 90s. But Dean Witter used to be one of the biggest futures brokers in the United States. In 96, I moved off the floor when electronic trading started taking off. CME had Globex, Board of Trade had Project A, NYMEX had Access, and it was a new thing, being in my 20s, electronic trading, really appealed to me. In 1997, I left Dean Witter. I joined EDF Man on their global trading desk. EDF Man is a big commodity trading firm. It's English based. It's been around since the 1700s. In the following year, in 98, I left EDF Man, joined Commerce Bank in Chicago at their upstairs trading desk. And, it is predominantly fixed income products, bunds, bonds, bobbles, shats, 10 years, 5 years. And in 2002, I joined Cargill on the futures trading desk, also in Chicago. If you don't know, if you're not familiar with Cargill, it's probably the largest privately held company in the United States. They got operations almost in every single country around the world, and they account for roughly 24-25% of the United States grain exports. McDonald's get all their cooking oil from Cargill. When I joined it, I thought it was just a big commodity trading firm, but they really trade everything around the world. Interest rates, currencies, commodities, anything that's tradable, they trade. In 2004, they asked me to go to Singapore to set up a trading desk there, so I left Chicago, I went to Singapore. In 2004. In 2006, I joined JP Morgan on their futures trading desk as a vice president. And I worked there until 2013 when I retired. I was 43 when I retired. I retired for personal reasons, start a family. I was getting a bit, I don't want to say getting old, but, in the finance world, especially in the trading world, if you don't stop and take a break, then, the world will pass you by. 2015, I founded orderflows.com. I found that there was just a lot of bad information out there for trading, for people that want to get into trading. People would come to me, ask them to teach them how to trade, since I was trading for myself, and I noticed the void, so I started orderflows.com. So, why do I say all that? I don't say that to brag, hey, look at my background, I worked at all these big companies. I say that because you got to ask yourself, think about it in other terms. Where do you get your medical advice from? Do you go to your doctor, or do you go to Google and type in your symptoms and see what comes up? If you go to Google, I like this picture here. The guy checked his symptoms, and according to WebMD, he's dying of 6 terminal illnesses. And a lot of people, when they come to trading, they don't know where to start. So the first thing they do is they go to the internet and they start searching. And there's a lot of bad information out there put out by people that, quite frankly, never traded, at least never traded professionally. And that's why I go over my background, so you can see that it's real, it's solid, it's good, a good basic, and that's what I try to put out there for everybody, and so they can learn. Because a lot of people, they just don't have the good information, and a lot of the information they get on the internet, you don't know what's good, what's bad. Okay, so let's get started. So order flow, right? It's a great tool that not only identifies where the market has been, how much volume has been traded, but also there's other things to look at in the order flow. You should always be asking what is going on with trading. Is trading activity drying up? Is trading being facilitated, or is it increasing in one form or another? From a price area. The purpose of the market is to facilitate trade. That's why the markets were invented, right? They were invented for people to hedge. They were invented for people to transfer risk, and that's why price rotates up and down, because people have a value, a perception of where price should be. Order flow describes the way orders are being traded in the market when they are trading. As orders are flowing into the market and trading, whether they're being executed on the bid or on the offer, will determine how they appear on the order flow footprint chart. Now, there's some debate, whether you're trading with a dome or you're trading with a footprint chart, which is order flow. Well, with the dome, you're seeing orders going in. With the order flow footprint chart, you're seeing actual trades. So what's more important, people's intentions or people's commitment? When you do a trade, when you get into a trade, you're committed to that position. You have a commitment in the market. If you just throw in an offer above the market, you're not committed. That's just your intention. Until you have something on, you're not going to have a reaction if you got to get out, right? So for me, order flow is the footprint chart. It's the actual trades that are executed and showing up in the volume. So the footprint chart takes the trades that happen on the bid or the offer and puts them into an easy-to-read format, and it conveys more information to an experienced observer about the ongoing market developments that one-dimensional candlesticks or bar charts just don't expose. You won't see these things that I'm going to talk about on a normal bar chart. And I want you to understand in terms of the behavior of the traders you're trading against. If you can't, everyone says, trade with the institutional money, trade with the big money. Well, yeah, that's great, but how can you determine on a bar chart if institutional money is coming into the market or not? If big money is coming into the market, you can't, because the information is just not there. So quickly, so order flow chart, this is what it looks like. There's a lot of numbers here, and honestly, to a lot of people, it's very intimidating at first glance. But once you understand what makes up one of these charts, it really puts all the pieces into place, and you'll understand what's happening in the market a lot clearer and a lot faster. And to give you an example, when I first went on to the CME trading floor, I went down there because my interview was on the trading floor with the desk head, and I swear I walked down there, everyone's yelling, shouting, flashing doing these weird hand signals. I had no idea what was going on. It was very exciting, very exhilarating, and it wasn't until I started working there that I understood how organized it really is. The news, they always show the trading floor. They like to show the trading floor when it's busy and because it looks chaotic, but it's really not. It's extremely organized. People know who exactly they're talking to, who they're dealing with. And the order flow chart really takes a lot of that information and puts it into an easy-to-read format. So you can see, the volume that's traded on the bid at a price level, the volume traded on the offer on a price level. You can see if there's market imbalances, that would be these blue numbers if it's a buying imbalance, a red number if it's a selling imbalance. The point of control, the point in the bar that traded the most volume, so like on this bar, just looking horizontally, this price level has traded the most volume here, right in the middle. Sometimes you have, very aggressive buying and you get stacked imbalances as the market's moving up, as you can see here at the 21, was at 34.5 up to 21.35.5. So you're getting a lot of information that a normal bar chart, this is the bar chart for that same time period. And, if, I just watched the presentation on Ichimoku. It's interesting, I did have a lot of experience trading with candlesticks before, so I'm always interested in different formats of trading. But one of the problems that I had with candlesticks is, when they work, they look brilliant. When they don't work, they don't look that good. Okay, like here, right? The market shot up. Okay, you have candlestick guys or girls will come out and say, well, yeah, you have a hammer down here. Okay, well, here you also got a hammer, and then the market went lower. People say, well, this one came off because you got this type of candle. Well, you got the same candle here. It came off and it went back up. So, there's a lot of information that you're not necessarily getting on a normal candlestick chart or a bar chart. Now, go back to the basics. Trade is facilitated by price discovery, bids and offers that establish the range. Price stays in a range of mutually agreed value until the perception of value changes. Price will then break out with either the buyer, seller, or seller being dominant. Then the market trends. The market will stop. The market will often develop around that stopping price. That's the area where you get some consolidation, right? You've seen it lots of times. The market makes a move, goes sideways. And that's where the market is developing around, and it's found its new value area. And then the process begins all over again. This happens all day long, in all time frames, in all markets. So once you understand that, you'll understand how the market works. Now, you can't replace this information with oscillators or with indicators, overbought, oversold, things like that. And you have to understand why the markets exist and why markets move. Markets move because they're looking for value. Okay, once you have your value area, you move up, price gets rejected, you come back into value. Maybe it goes lower, price gets rejected at the lower price levels, it goes back into value. Markets move to find value. So what's the importance of order flow analysis? Well, there are many different pieces of information that can only be seen with order flow, each of which can be used to build your trading method around. Today I'll talk about 3 of them. I know people that have adapted flow just for one piece of order flow analysis. I'm not saying you got to take everything, because there's a lot that you can deal with, to digest in order flow. But even if you just take one piece of order flow, it can transform your trading immensely. So the first thing I'll look at is bid volume and offer volume. Knowing if traders are aggressive in moving the market. Points of control, which is going to be the value area, and price rejection, lack of follow through in a move. So first, how can you profit from seeing the bid volume and the offer volume? Well, ask yourself, why does the market go up? Don't say there's more buyers than sellers. No, for every buyer there's a seller. Why do markets go down? Are there more sellers than buyers? No, of course not. You have more aggressive sellers than buyers. Markets go up because buyers are accumulating the inventory. That's demand, right? There's a lot of demand in the market for a commodity, so prices will go up. Markets go down because sellers are distributing their inventory. They have a lot of supply, right? Say you're a department store and you got a lot of winter coats, and all of a sudden it's April and you're sitting on 1,000 winter coats. Well, you put them on sale. You lower the price until you can distribute that inventory out to the public, right? That's, when a market's selling off, price is going lower. People are distributing their inventory. They're getting it off their books. Now, this is economics 101. If you've ever taken an economics course in high school or university, they talk about the law of supply and demand. It's not the theory of supply and demand. It's the law of supply and demand. Whether you're trading crude oil, whether you're trading E-mini S&Ps, you're trading bananas, or sunflower seeds. Believe it or not, there's actually a futures contract on sunflower seeds. But the same rules apply to trading futures, trading stocks, trading forex as it does to selling your house. Okay, so the futures market and most traded markets are a two-way auction. There's a bid and there's an offer, and essentially there's four ways you can trade, right? If you want to buy, you can either pay the offer price with usually a market order. You just, it's offered at a certain price, you pay that. You are being aggressive. Or the second way to buy is you can work a bid. You can work a limit, on the bid or below the market. That's considered passive. Or if you want to sell, you can sell at the bid price. You can use a market order. That's being aggressive. Or you can sell thinking, I want to sell, but not at this price, maybe a little bit higher. Then you work a limit above the market, or you join the offer. That's considered passive. Now, when you're aggressive, you're going to get into a position no matter what. If you're passive, you may or may not get into the position. You're willing to get into the position if price goes there. If it doesn't, you're not going to get in the position. When you're aggressive, you're getting into the position right away. So there's two types of traders now. You have aggressive traders and you have passive traders. And by looking at the volume traded on the bid and offer, you can discern if traders are being aggressive or not, and how aggressive they're being. So again, people lose track of order flow because they start thinking of all these numbers, but you got to put it in simple everyday terms, right? Say you want to buy a house, right? Most people, you bought a house, and the house you're looking at, you want to buy is $250,000. Now, what can you do? If you really want the house and you pay the offer price, you don't want to wait. Maybe somebody, you think it's a good deal, or there's 10 other people also want to buy the house. So you pay the offer price. Are you being passive or are you being aggressive? Well, you're being aggressive because you want to get the house. You want to own it. If you like the house, but maybe you think 250 it's not really worth it. Maybe you think, well, the landscaping is lousy, or too many trees, you got to cut it. Then you say you like it, but not at 250, but at 220, I'm happy to buy it. So you work a bid, $220,000 bid for the house. That's being passive. So now it goes to the seller. So the seller sees your bid, $220,000. Well, the seller has a choice. He can either be passive or he can be aggressive. If he wants to be aggressive and get rid of the house, for whatever reason, he just goes down to your price. He moves down from $250,000 to $220,000 and sells you the house. He's being aggressive. If the seller says, nope, I know I can sell it at $250,000, I got 5 other people coming to look at it today, chances are someone's going to pay it, he's going to stay at $250,000. He's being passive. If he was aggressive, wants to get rid of it, he goes down and hits the bid. And if he wants to be passive, thinks he can sell it at a higher price, then he's being passive. So now that we have identified the different types of trading that's happening, it's time to put it in context. So a market will move up when all the offers at one price have been bought. Conversely, a market will move down when all the bids have been sold. So this is an order book real quick, and the market is 49.45 bid, 49.46 offer. You can see there's 6 lots on the bid, 23 on the offer. So all these people that are working offers above 49.46 and above, these are passive sellers. They're waiting for the market to come up to them. They may not trade up there. They may not get filled. And the converse is true. 49.45 and below, you have a lot of passive buyers, people that are waiting for the market to come to them. Now, if a person thinks that, say this is crude oil, right, 49.46, say you're a trader and your brother works on an oil rig somewhere and there's a fire, and he messages you, hey, we got a fire on this big oil rig, and you think, hey, when the market sees that on the news, price is going to go higher, so you want to be aggressive. You start, you buy the offer, you buy the next offer. That's being aggressive. You are buying the offer. And conversely, if you think the price is going lower for whatever reason and you want to sell it now, you think, we're trading 49.45 bid, and you think we could hit 49.20, you start selling it. You hit the bid at 45, you hit the 44s, you hit the 43s. You are being aggressive. So all this is translated into the order flow chart. And again, order flow is the way orders are being traded in the market when they are trading. As the orders are flowing into the market and trading, the footprint chart takes the trades on the bid and offer and puts it into an easy to read format. So, you can see here, right, like I explained a little bit before. Okay, like for example here, this price at 21.34.5, 303 traded at 21.34 and 3/4, 540 lots, 542 lots traded. So when the market was bid and offered here, 303 traded and 542 traded. Now there's going to be times where you have selling imbalances. That will be the red number, so 773 against 16. That's a ratio of greater than 400%, and that will tell you if there's a selling imbalance, and a blue number would be a buying imbalance, so it's 42 against 186. Now with software, a lot of software out there, you can adjust the setting, whether you want to use 1,000%, 600%, 400%, 300%, it's up to you. The industry standard is about 400%. And I say you don't see a lot of imbalances generally in a bar, but when you do, it's telling you that traders are really being aggressive, price is moving. So, how can you use this information? Well, when you start seeing a lot of imbalances, you know that sellers are really in control. If it's selling imbalances, if it's a lot of buying imbalances, buyers are in control. Now there's a little bit more information that you'll get on an order flow chart, and that's called delta. Now delta is the difference of the volume traded on the bid minus the difference of the volume traded on the offer. Now why is delta important? Well, that's going to tell you who's in control of the market. So if you have positive delta, like this 492 here on this middle bar, that tells you, buyers were in control. And what happens? The market's moving up. The next bar, you got a positive delta, 3,484. Market's moving up. Buyers are in control. You have net more buyers in these two bars than net sellers because you took all this volume traded on the bid side in the bar. You minused it from the volume on the offer side. That's how you get your headline delta number. If it's negative, you would say sellers are in control. Another piece of information, very important, max delta, min delta. And what that is, it tells you how max delta is how most positive, the wording doesn't sound right, the most positive delta was in a bar. So you can see here in this one bar, this big red bar, 0. So there was never at any point were buyers at any point in control in this bar. It was all dominated by sellers. In this next bar, you got a max delta of 509 and a min delta of 1985. So min delta is the most negative it was in the bar. So you can see in this bar here, in the swing low, at one point we had a very strong negative delta. Sellers were in control early in this bar, and buyers took over. You ended up with a positive delta of 592. So there was a big shift. There was a shift in supply and demand, and that's information that you can only get by looking at an order flow chart. You're not going to see this information on a normal bar chart. Okay, so how do you use this information? Well, do you ever wonder why a market will pull back to a certain level in the market and not get past that level and continue down? This is what was this? This was Wednesday, or the 17th, in the E-mini S&P. It's a 1-minute chart. Okay, just after the cash open, right? We popped up here, started selling off, and we got this level here, right? I drew this box in here. You can see prices staying below it. We come back up, and then we sell off. I mean, wouldn't you like to know why we come up to this level? We can't get past it. Lots of times you're trading around. Sometimes you see, these price levels that price, comes back to, can't get past, and then sells off. Okay, so how does it look on a footprint chart? Well, this is how it looks here. You're seeing a lot of numbers, but really, like I said, you're not keying in on every single print that happens. What you're looking for are areas in the order flow. Like in this case, you're seeing imbalances, right? Where you're seeing what's traded on the bid side against the offer side. In this case, these are selling imbalances. Red numbers in the bar tells you have selling imbalances. You have very aggressive selling happening here. So you got 2 here, you got 3 here. Now for order flow traders, we call that a stacked imbalance because you got 3 imbalances stacked right on each other. And oftentimes these levels act as support or resistance. I mean, if it's a selling imbalance, it's going to be resistance. If it's a stacked buying imbalance, it should be support. And what it's telling you is, you have aggressive sellers coming in. Okay, they're overrunning the buyers. People are bidding here, and these sellers say, "Screw you! I think the market's going lower. I'm selling, everything you want to put out there." And what you look for is the price to rotate back up into that area, and you're looking for the sellers to reappear. And what do you get? You come right back in the next bar. You got another imbalance here, right at this level, right in the middle, where you have this stacked selling imbalance. So you see the sellers are still there. They're still waiting there to sell the market. Hey, if people want to bid 21.25 in the 3/4, I'm happy to sell it to you. They come in, boom, they sell it. And then what happens? You just sort of pop back up. You're still a little bit hesitant to get back in there. Then the market sells off because there's these sellers here, right, at this area. So I mean, that's how you can use order flow to your advantage. You said if you're looking at a normal bar chart, you're not going to see this information here. You're not going to know in this bar that, hey, we have this market-generated resistance level, okay? And if we come back up in there, it could be a low-risk entry because, you're going to get short in here. I mean, if you're getting long, you got to run into this area right here, so maybe you'll think twice about getting long, but really you should be thinking about getting short up here because, it's going to give you a very low-risk entry because, you could just hide just right above this, right above that, where's that, the stacked imbalance zone right up in here. You can just hide behind here with your stop. So you have a very low risk trade. You're just talking a few ticks. So that's how looking at the bid and offer volume, will help you in your trading. So the next thing I want to talk about, and it's something that a lot of people don't even realize, and you could almost determine where support or resistance will be in the next bar before it happens. I have this picture of Jack and the Beanstalk. It's like, the story of Jack and the Beanstalk. The guy had the magic beans. Imagine someone comes up to you and says, "Hey, I could teach you how to determine support or resistance will be in the next bar before the next bar even forms." And would you be interested in that? Honestly, if you say no, I think you're wrong, but you should be. And why does it happen? Why does a move happen and a bar pulls back to a level, stops, and then continues in its original direction? Well, I'll tell you, each bar has what's called a point of control. And the point of control, the POC, which some people refer to it as, is the price level in the bar with the most volume traded on both the bid side and the offer side in that bar. Now, the order flows trader software will outline it. You can see it here. You can see it here. You can see it here. Each bar has one point of control, and that's the area in the bar that traded the most volume. Okay, it's not compared diagonally, it's compared horizontally. Imbalances are compared diagonally, but point of control is compared horizontally. Now, so what? You're probably asking, well, on a normal candlestick chart, a bar chart, you don't know where point of control is. Okay, so you see, this might be a little hard to see. We're coming down, then we go up. But you see each bar pulls back to a certain level, right? We pull back to a certain level, we pull back to a certain level, then go up. Pull back to a certain level, go up. Well, how does it look on an order flow chart? Okay, you start your move down. You have your point of control here. We're still below it. Next bar right here, point of control. Okay, and maybe you're going to pull back to within a tick or two of this. Next bar here, you get one tick through. Next bar, a little bit lower. So now you're going to say, hey, I think we're going to start to rally. You have your point of control here. The next bar is the same level. Again, you got through one price here. You're starting to move up. Point of control. Sorry, this price bar, you pulled right back to the point of control. Go higher. Point of control is here. And the next bar, you pulled right to that point of control. Next bar, you pulled right to that point of control. So, it's acts as support or resistance for the next bar. Now, it's not always 100% true, but it's pretty accurate. And, so as the market moves lower, it often retraces back up to the previous point of control before continuing lower. As the market moves higher, it will often retrace back to the point of control of the previous bar before continuing higher. Okay, so this is a 3-range chart. It's a little hard, but here's the 10-range chart. This was on the 18th, so about Wednesday, I think that was. And It's a 10-range E-mini chart. You can see here, right? We came down, and then we started going up. Okay, so what happens? In this bar here, you have your point of control at this level. The next bar, you came within a tick of it. Then you got a new bar, a new point of control. The next bar, you came down with, got one tick through it, traded very small, 127 through it. Now you got a new bar, new point of control. You traded within 2 ticks of it. Next bar, up again. You got your new point of control. You traded within 1 tick of it. So, this market generated information, and it's only available from the order flow. So, if you're looking at a normal bar chart, you're not going to get that information. And it's based on what just happened, not what happened hours ago, days ago. People like to draw support or resistance, on daily charts and try and trade intraday. Well, yeah, you can, but you're not going to have, a good guidance. I'll get into that a little bit later. But, let's look at it how it looks on a normal bar chart, right? This is that same, this is the order flow chart. This is the bar chart. Okay, so the market's moving up, right? Imagine, you're sitting here, you're thinking, hey, I'm long in here, and I want to know where I can trail my stop. Well, you're going to hide behind, the point of control, or say, hey, I think we're starting to move up. Where can I get long? You're going to look in an area where the point of control was. You got your 2 choices. Your new bar forms. Can you get long now, or can you be patient, wait for a pullback, and have less at risk? If you get in as soon as the bar opens, you're getting in at a higher price. You're not taking advantage of a possible pullback. So, wouldn't you like to know where in the next bar support or resistance can be? Again, imagine you're saying, hey, I think this is going to be a swing low. We're going to go higher. Okay, maybe you're 2 bars into it, and you're thinking, okay, now we're trading 21.33.5. Well, I know my point of control is down here at 21.32.25. I could throw in a bid somewhere around here. Wait for the pullback, and then you get in here. You're saving, a point and a half on your entry. And conversely, if you want to trail your stop, you could hide behind these points of controls, give a little bit more space. I mean, a fixed dollar amount. You could be using the order flow to your advantage to have, better risk management. So why is this? If you don't understand why this real-time market generated support levels are important, well, every guru out there, right? They'll say you have to follow the big money. But honestly, what you should be doing is you trade around the big money, because when big money comes into the market, especially nowadays, there's so much going on in the markets. You don't know if it's a new position, someone getting out, if it's a hedge, or what have you. You have no idea what is going on. So you may see a lot of activity at a price level and think, well, a lot of buying. Think, well, the price is going higher. The big traders, the institutional money, they're buying. Well, you don't know why they're buying. So just to follow it because there's big numbers being traded is wrong. What you can do though, you trade around that big money. Once you understand why it's happening, you can either hide behind it or join it. So institutional traders, and I know this because I was one for 20 years. You don't base your trading decisions off smaller time frames. I know very, very few institutional traders that trade using minute charts. Most trade off daily, weekly, or monthly charts. Yeah, some trade 240 minutes, 480-minute charts, some even hourly charts. Very, very few trade off of intraday charts, and the ones that do trade intraday charts, it's very specific to one market. Most institutional traders, they sit back. It's like the scene in Trading Places in the beginning where Dan Aykroyd's like pork bellies. It's not something that they're looking to get into and out of in 5 or 10 minutes. They're holding it for weeks, months at a time. So they're referencing longer-term charts. But when they're buying or when they're selling, it's going to show up in the order flow. Their activity can be used to determine short-term support or resistance. If a big fund has 5,000 E-minis, 10,000 E-minis to sell, they're going to leave a footprint. They're going to leave some support or resistance in the market. So as a retail trader, there's no stigma to retail traders. You're either a retail trader or you're an institutional trader. So unless you're working for a bank, you're a retail trader or a big trading company. Intraday retail traders trade in smaller time frames, which generally trade in minutes, ranges, or volume. And if you're trading on a smaller time frame, you should really be referencing smaller time frames based on what's happening now. You shouldn't necessarily be looking at support or resistance on a monthly chart. I mean, yeah, you can, but what impact's that gonna have on the next 5 minutes? You're trading a 1 minute chart. You're not holding it for a day or 2 days. You're holding it for 5 minutes, 15 hours would be considered long on a 1 minute chart. So hopefully you'll understand now how you can use point of control as support or resistance, how you can use real-time market generated information from the order flow as support or resistance. Okay, so the next thing I'll talk about is price rejection, how to see areas of price rejection as it occurs. So the market, you're either going to have acceptance of prices or rejection of prices. When your price is being accepted, that's where you're going to be trading sideways, trading in a range. Doesn't necessarily have to be one price level. It could be 2 or 3 points. Price is being accepted, price is transacting. The market's finding its fair value. But when the market moves up, it's going to go up until price gets rejected. Why is price going to be rejected? Well, maybe the last buyer has bought. Then it sells off. When the last person buying it is done buying, where's the support in the market? Price is being rejected. Buyers have rejected these higher prices and not buying anymore, and the market sells off. And conversely, when the market comes down, the opposite is true. The last seller has sold, and then the market is, there's no more downward pressure, the market snaps back up. So order flow will allow you to see areas of price rejection as they occur. And that's a big part of trading that many traders lose sight of, is the purpose of the market, right? The markets exist to facilitate trade. I explained that earlier, right? It's a two-way auction. There's a buyer and there's a seller. Some traders call this facilitating trade. They call it noise, right? But this noise is the market doing what it's supposed to do, facilitate the trade. Buy, sell, sell, buy, 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 sell, sell. It looks like sometimes it's without rhyme or reason. You're just seeing a lot of back and forth trading. Well, that's what the market exists for. It exists there for people to transfer risk. It exists for people to find value and buy stuff to make things with. But the market stops, right? It gets it to a price level and it stops. Well, why does it stop? Where does it stop? Oftentimes, you got to think of price rejection. Traders are rejecting prices as either being too expensive or too cheap. Okay, so how can you tell that in the order flow? So this is Monday, right? This is October 17. Just after the cash open, we rallied a little bit. We popped up, made new highs, 21.30, started selling off, hit this area here at 21.28. Looks like we're going to go back up. Instead, we just sold off 9 points pretty quick. And if you're looking at a bar chart like this, well, how can you know? I mean, it's hard. Again, people say candlestick highs will maybe come up, well, you got this here or that there. Well, I'm sure I could show you other cases where it didn't work as well. And let's take a closer look. So, this is your high here. You come off, boom, boom, boom. And, we start going lower again. Okay, so how does it look on an order flow chart? Okay, you can see here, you have very little volume, 4 lots, 9 lots. So the market starts selling off. People aren't interested in buying it that they could hire. You got very low volume, at the extreme of a bar here. It's what I call single prints. 4 lots, it's 9 lots. I also have what I call ratios here. I take the order flow and give a ratio, certain ratios that I like to look for. But this was the sign that you're seeing price rejection. You didn't see any more interest in people taking it higher because you've seen very small volume being transacted. So that's one of the things. Order flow is giving you that information. Like I said, you saw the bar charts earlier. You're not going to see that information on a normal bar chart because you're not taking advantage of the information that's out there. Okay, so this is a 3-range chart. It's a very fast-moving chart. Very small bars. This is yesterday, right? This is a crude oil 15-minute chart. Okay, remember crude yesterday? We sold off quite strongly. So we come down here 50-50, and we start to bounce back up. Almost to 5100. And it's a 50-cent move up. You're thinking, hey, okay, this is our low. We came down here quite sharply. We're starting to rally. But what happens? We sell off again. Okay, well, is there any information you could get here? Well, again, I'm sure people will say, well, if you have an average, moving average, we broke that average, or what have you. You got an engulfing pattern. Yeah, I mean, it's easy to look after the fact and say, yeah, you had that. But really, what you're doing when you're looking at the market in real time, you want clues as to what's happening that's going to help you want to take that trade. I said we can all look at charts after the market closes and say, yeah, here and bought back here. I mean, but realistically, when you're trading, that's not going to happen. So this is the order flow chart, and you can see right here at the top. This is right here. This bar is right up here. You have a single print. That's a sign of price rejection. And then what happens? You sell off 50 cents. Okay, so it's going to give you a low-risk trade. You know that if you got price rejection here, if you start trading back up here, you get past this level, price rejection, price isn't being rejected anymore. So you should be out. Okay, so you're risking this little part here to get this. You're risking 10 or 15 ticks to get 50 ticks. What would you rather do? Would you rather risk 10 ticks to get 50 ticks, or would you rather just sort of take a shot in the dark here and say, oh, I think I'm gonna get low, but then not know where to get out? That's how order flow will help you. It will help you determine low risk areas. Okay, so just real quick, I'll go over a couple of trades that I had yesterday, and this was yesterday here. S&Ps, I got a quick 2 points, and it's the order flow. You got stacked imbalance. You got some price rejection here. I saw the delta flipped and a rally back up. Second trade, again, aggressive selling coming in. I got short at 34 and a quarter, got out at 29 and a quarter. So this is 5 points in the S&Ps. This other trade was 2 points. And this sort of stuff happens all day long, every day. Although yesterday was a nice day, but you know what? If you see these same things happening all the time. So just real quickly, I'm not sure why you showed up today. Maybe you saw my picture on the sign-up page and thought, hey, this guy looks smart. I'll listen to him. Or maybe because you're tired of making the same common mistakes other traders make. Maybe because you are thinking about using order flow but don't know where to start. Maybe because you're fed up with all the crap out there on trading. Maybe because you've thrown away already a lot of money, and I've met people that have thrown thousands of dollars away, tens of thousands on trading indicators that don't work. Maybe because you're looking for a couple little tweaks and tips for how you can add order flow to your trading. Maybe you're already profitable, but you want to add a little bit more to it. So the obvious question is, how do you use order flow when you're trading? Well, there's two ways. You can do it slow. You can use trial and error. Some of what I taught you today, you can use that information now and look at an order flow chart and start using it. You can do it fast. Say you don't have the order flows, any type of chart. You get the order flow trader package that I have created, with proven methods of this market analysis. Right? I said I've been trading at the institutional level for 20 years, and what I have to share with you is valuable information. And what the order flow trader software package is, it's the order flow trader software, the delta scalper, delta candles, price rejector. These are 3 additional indicators that help you read the order flow. It's not a system. People have developed actual trading systems around the delta scalper and price rejector, but for me, I'm an old school person. I like to make decisions. I like to be highlighted. These are more of indicators that slap you upside the head and say, hey, idiot, don't miss what's happening right now. You also get the order flow trading course. It's a 15-hour trading course. It's online. You can watch the videos. You can download them. I also have the PDFs that go with them. It's a course that I created to explain literally everything I can think of on order flow trading. And for now, also you get access to my trading room, my order flows trading room, where I spend 2 hours a day live trading. So you can see what I'm looking at. You can see my screen. You can see me getting in and out of trades. And so you get a lot, right? And next question, what's this going to cost me? Well, I said normally my software I sell by itself for $900. The Delta Scalper I sell for $250. Price Rejector $350. Course $297. The order flow trading room is $299 a month. I've actually had to close it to outside traders. It's just now for my customers, people that use my software. I'm giving you all this for just $999. I think that a couple good trades will pay for it, honestly. Now, so what do? Right now, go to this page, orderflows.com/webinar, and look for this button. It says "Let me in." You click on that. So this is what it is. You go to the web page. I'll put the link in the chat, and this is the top. You scroll down to the bottom. There's a button down here. There's a lot of videos about some of the indicators. I actually have a couple free things in here you can go to. What a little pamphlet I created called Hidden Trade Locations. Another one called Delta Surge. This Delta Surge is an indicator that you can use tomorrow on your trade. People are using it and actually making money with it, and I'm giving it to you for free. I mean, other people will sell an indicator like that for $500, but it's there for free. So when you click on this button, "Let me in," you're taken to this page. It's processed by PayPal, so you're not giving me your credit card. I'm not out there just trying steal your money or anything. It's by PayPal, so if you've got any problems, you go back PayPal and we'll work it out. So again, it's you have a 14-day period. If it's not working for you, because sometimes, let's be honest, order flow is not for everybody. If you find it's not for you, then you can ask me for a refund. That's all. So thanks for watching this. Again, go to orderflows.com. My webinar is www.orderflows.com/webinar, or you can email me, mike@orderflows.com, for any questions. Go to YouTube. I got a YouTube channel. I got tons of videos on there with a lot of trade recaps, things just talking about the market. Subscribe to us. When I post a new video, you can see what's what I had to say for the day, and maybe you could pick something up. I said I know a lot of people out there are using different order flow software. You don't have to use mine, but I teach how to use order flow even if you're using a different software. One quick question is, how does it work? It runs on the NinjaTrader platform, so you can download it for free if you're not familiar with it. Most traders are already familiar with NinjaTrader. Go to ninjatrader.com. You can download it for free. They have a paid version, but the software will work on the free version. And I'm a futures guy. I'm not a forex guy. I'm not an equity guy. My whole career has been in futures. I prefer futures over stock. I trade stocks, but that's more for my retirement account. It's just buy and hold. Forex, there's futures on forex, so that's what I concentrate on. So thanks for watching this. Hopefully you'll pick something up that you could use for your trading. If again you got any questions, just email me. I'll try to get back. I might not get back to you in an hour. It might be a couple hours. It might be 12 hours or a day. But I'll do my best to get back to you. So again, any questions, just shoot me an email or go to my website. I've got a lot of educational stuff on there. So go to www.orderflows.com/webinar.